Hey, my name's James Nicholson. Welcome to my YouTube channel. Now, in this video, I'm going to tell you why house prices won't crash 40% in the next 2 years. Now, make sure you watch to the end because I really want you to get an understanding on this. This is just my opinion, right? This is my opinion. Now, I know the comments, you guys are going to absolutely flame at me on this video. I expect it. So go on, guys, do your worst. Tell me in the comments how I'm wrong, how I have no idea. Maybe you're right. Maybe you're right. I don't have a crystal ball, but I believe that prices will not crash, and I'm going to cover that in this video. Why? But before we jump into that, I'd like to invite you on a journey with us. Now, this YouTube channel is all about my investment journey. I'm a property investor of 23 years now. I've got a great little portfolio that I'm going to be expanding this year, and I want to take you on that journey with me to see the good, the bad about property investing. But more interestingly, I'm building a portfolio for my two little baby girls. One's a big girl, she's 21. We bought two properties this year so far. We bought a house up in Doncaster. You can see that on the channel already, actually. We bought it at auction, we refurbed it, and we covered all of that behind the scenes on this channel, so do check those out. And we're building a portfolio for my little baby Amelie, who's just one. So take that finger of power, spin it round, smash subscribe over there, and hit the bell notification, because you don't want to miss out. Now, when was the last big property crash? Well, it started in 2008, right? The credit crunch. We can't forget that, right? I'm 41, so if you're anywhere near my age, I'm sure you remember that, right? All the doom and gloom. So first off, why did that happen? Well, banks were lending money to anyone with a pulse, basically not even a checkbook, with a pulse, right? They were lending money to absolutely everyone. And in America, it was very, very bad. And so they just lent money willy-nilly out in America. But we did the same, right? And so Bradford and Bingley, do you remember those? Bradford and Bingley, they had a product where you could borrow, this is bonkers, right? I'm thinking about this now. You could borrow 130% of the value of your property, right? So Georgia, my daughter, we've got a house now in Doncaster that's now worth 100 grand. We bought it for 60, but we've done some work and we've got it to be worth 100 grand. So that means that we could borrow against that house £130,000. Well, that was bound to go wrong, wasn't it? It was bound to go wrong. In fact, that was a rare rate. Like not many people were able to borrow that much money, but a lot of people did borrow £110,000, £110% of the value of the property. You see, we'd had such a good run of house prices going up at that point in 2008. And so banks would lend huge sums of money on the back of the house prices would continue to rise. Or if they stopped rising or dropped, that people wouldn't stop paying the mortgage, right? And so interest rates back then were at 6% as well, which is way higher than we have right now. Now, look, I know that I've made videos recently that is predicting that the base rate is going to go higher than 6%. And that means that you might be paying 9% or 10% even for a payment, which is going to be really, really tough. Now, things changed. And so a lot of the banks failed. And this office where I'm in right here is about 4 doors up from now what is a Virgin Money, but used to be a Northern Rock. And do you remember people were lining up? I remember people lining up to get their money out of the bank, and they were there for days. Like, I think it was like a whole week. People were just lining up to try and get their money out of Northern Rock before it failed. And so there were a lot of lax rules back then. And so, as I said, one, the banks would lend silly amounts of money. They'd lend you more money than your house was worth. And that happened all over the country. Two, interest rates were a lot higher than they are now. Now, we know interest rates are going to be rising, so that could be a big problem for us down the line. Of course, we need to consider that. But the last thing is that they would lend money to anybody, right? And I was borrowing money at the time on a self-certification mortgage. And I know of friends, particularly that were builders, that would go into a mortgage advice, like into their broker, and they would like fudge the numbers. So builders that were on like 30 grand would say that they were on 100 grand. And you know what? The bank would lend them money as if they were on 100 grand. There was no real checks back then. It was just, you said how much you earned. Now that's changed considerably. And so those people that think that the market is going to crash are basing it off this 2008 period, or maybe they've never bought a property. I don't know. But the fact is that if you buy a property now, they are really, really checking everything. They're checking all your employment status, they're checking your credit rating, and this sort of stuff wasn't happening as much back then. It wasn't really a big deal. And so they're also checking that you buy a property and that you can afford it at the higher interest rate. They've already factored that stuff in before they'll lend money. So getting a mortgage has been a lot harder since 2008, and it's stuck that way. The amount of background checks that they do is insane. Like when I just bought my house in Dorking, this new project that we've just done, 2 lenders declined me because I had just purchased all the kitchens and all the renovation work on my credit card and pretty much maxed out the credit card, and I'd paid it off a few days later, but they got the timing wrong. And so when my credit agency did their update, it said that my card was pretty much full. And so the bank wasn't comfortable to lend because they felt I had a full credit card. And so we had to adapt that and move with a different lender, which was fine. But that is something that happens now, right? They are really thorough. And so the other thing that's happening is since 2008, we have a lot more people in this country. We have a lot more people in the country. Go and look at this, the details online. Millions more people live in this country, and we're not building enough properties. We don't have enough houses. And so that keeps the prices higher. And those of you that want the market to crash and have a correction, I'm not saying that it won't. I want to be very clear here. I'm not saying the market isn't going to crash. I'm saying it's not going to crash 40%. It might go down 5, 10 or 15%. That's possible, right? And it very easily could happen. And that would be the same as the 2008 crash, which was a big one, right? It was a very, very big crash back in the day. But since then, banks also have to prove to the Bank of England that they can survive a property market crash. Because what was happening in 2008 was that lenders were going bust because everyone was just handing back the keys and saying, look, I don't want this house, repossess it. I don't care. I don't want something that's worth 15% when I owe 130% mortgage. Take it back. And so that meant that banks were going bust, and now they have to prove that they can survive these downturns. And when they go bust like that, like they did, that meant that lending stopped, and that was one of the bigger problems there. Now, we've got some lending paused at the moment, but it's not stopping. Banks have already today, this is Monday I'm recording this, have started putting in deals back on the market at just a slightly higher rate. Right, that's all that's happening at the moment. So I don't think house prices are going to crash. I think the fundamentals are clear here. The banks are better funded than they were in 2008. Secondly, you get a lot more checks than you did in 2008. Thirdly, you cannot get 110% mortgage or 130% mortgage. They haven't existed for a long time. In fact, you don't really get 100% mortgages anymore either. So that's another factor there. All of the affordability checks have been in place for years. And so they're checking that when they're lending money, that you can definitely handle those payments if the rates were to rise significantly. So that's another thing. And lastly, we just don't have enough houses, right? And the government need to fix that. If you want house prices to be more stable, which I do, right? I don't want house prices going up 10, 15% a year. I know that doesn't sound like a logical thing to say. I would rather they just went up at a smooth rate, so we got more predictability rather than having huge rises one year and big drops the next. It's easier to be smooth and steady, and that's good for everyone. So I'm putting this out here today. I look forward to your comments. Be nice. You can disagree with me, but still be nice in those comments. So do comment your opinion below. Give this video a quick like, guys. That really helps with the YouTube algorithm. That will really help us get more views on this channel. Thank you for watching. Do go and check out my other videos, including this one right here. Bye for now.